Oh, hi there. Hey, I didn't see you there. Hey, it's Mark from stockpursuit.com and the Twitter/X account Stock Pursuit. So I put out a tweet about asking people about what kind of stocks they wanted me to analyze, look at the fundamentals, technicals. So the first one I'm going to do today right here is Tesla. So I'm going to talk about the fundamentals on Tesla, just a sort of brief sort of overview of everything that I see in my opinion of it. So looking back a few years, the revenue growth's been declining, which is not really, what you'd like to see in a growth stock or a you know super fast growing stock. Of course, like they have a history of revenue growth, but um, I don't know how strong it's going to be going forward. I don't think it's safe to say that they're going to grow more than 20 to 30, 40% a year. You know, they did grow about 20% last year, but I don't think it's going to be smart to expect them to grow like they have in the past every year. It's more they're kind of more established now with they've got about 70% of the market share in the United States EVs, so that's pretty good. And there's a lot of good stuff. So I'm just gonna kind of start with the bad stuff that I see, and that's one of the bad things is that the revenue growth hasn't been as robust as it has in the past, and it's been sort of in a decline the past 3 years. And the other thing, I mean, just look at the basics, the gross margins. They've been pretty stable. I mean, for a car company, like that's not super bad. Their margins are fluctuating a little bit, but they have been a little less stable recently. But I think it's possible that they could just they can keep the gross margins, but if they're going to cut prices a lot, and that seems to be the trend right now. I wouldn't expect the margins to hold up as well as they have in the past. So those are the two things: the revenue and the margins. And they're very important. So those are the two things that are kind of hurting them a little bit. And even though there are some bad things, the car companies are really hard. It's a hard business, and they're not really the greatest businesses in the world. Like you look at the margins on other companies, that even the S&P 500 or even smaller companies, they have better margins. So the car companies' margins are never really you know the best that there is out there. So that being said, they've done pretty well, obviously over the years. But the other thing is looking at the growth. So the growth is what matters the most, right? So the past doesn't really matter as much as the future. So how much can they grow? So I think looking at the price to earnings growth multiple, I looked at, which is like price to earnings over growth, and the PEG ratio. That's what they call it, the PEG ratio, PEG, PEG ratio. That's kind of like the sort of just a general way to look at it. I mean, you can analyze the cash flows, and the best way to analyze a business is project cash flows and do a discounted cash flow analysis. But I've never really found that necessary when you can get sort of the bigger picture and just the price to earnings and the growth. So that's one way to look at it, because the street looks at earnings too. Like earnings matter. So but just looking at the PEG ratio, it's about 2.5 right now. It's over two, under three. I think it was 2.5 was the price to earnings growth ratio multiple, which is it's not that bad really. Like it's definitely not undervalued. Like an undervalued price to earnings growth multiple PEG ratio would be one or less. So you don't really see that much. The S&P 500 has a PEG ratio of like over one now, like 1.3 or something, and that's really not even that expensive. Because you're not paying that much for the growth. You're paying sort of a fair value for the growth. So like But two over two is kind of getting there. Maybe overpaying a little bit, as far as if the stock's undervalued versus their growth. But for a company like Tesla, with a 70% market share, it's going to have, obviously more of a fuller valuation, and it's got 62 price to earnings multiple now, the 62 PE multiple. So that's on the higher end, for a big company like that. But there is that stability they have with being the number one in the U.S. market. So I can't say that it just based on those simple ratios and what they're likely to do with growth in the next year or two. I can't really say that it's undervalued or overvalued tremendously, because it's not, obviously. And the nature of the car market is really competitive. So you're only as good as your latest model, really. And but that's a good thing for companies that are trying to come back or start up. But through history, car companies they're almost like airlines. I mean, but there's people that are really fatty, like they're picky with cars. So you can see them come and go as far as popularity. So maybe next year, the next Tesla model won't be as popular as the previous year. Or you look at a company like like Hershey's, or just a stalwart company that has a brand that they can raise prices year over year with inflation. Those are kind of better companies. So Tesla, I wouldn't, just my opinion, this isn't financial advice, none of this is, but like I wouldn't put all my eggs in Tesla, with that being in mind, that they could lose margins more, and or even revenue, with the nature of the car business being really flighty. It's kind of a flighty business, through history. But of course, the major car companies stay around, but that doesn't mean they go through peaks and troughs. So there's going to be peaks and troughs, with if you're selling cars, it's just the way it is. But so it's definitely not undervalued. Just looking at the multiples, and the price to sales is like, it's over 5 times price to sales too. So it's not cheap by any means. One of the things I was looking at too is the the stock dilution's been increasing slightly, and you like to see the shares outstanding stable so that they're not diluted, because the shareholders, they're going to get their earnings based on the how many shares are out there. So it'd be nice to see. I think it would help them if they just did buybacks, like they announced a share buyback, even if it's just even for optics, like 2 million, or buy like 10 million shares back or something, or whatever, just to help out the shareholders a little bit, because there are a lot of loyal shareholders out there, as we know, with Tesla. And I think they deserve to not have the shares diluted. I don't know enough about the company, like what actually caused the dilution, but I assume it's just equity, like it's just raising capital, or maybe stock options or something, but or employee share program. But I think it'd be nice to see, and maybe this will happen. Probably it won't, but I think it would really help if they just did a share buyback, just announced a share buyback, even if it's the first time. That would really help the stock price in the short term, maybe the medium term too. So I know that's not really. They say that, like, I think Elon said he doesn't really care about the stock price, but you just should care about the shareholders, and not diluting them if you can. So not that that's necessarily a really bad thing, because the dilution hasn't been that bad, but it'd be just really nice if they could stabilize the shares outstanding, and that would probably give a lot more confidence, I think, in the stock too. But maybe it's not possible. Maybe they just can't. Maybe they have to raise equity or something. But I don't know about all the details. But that's one of the things I saw too. So So my final thoughts on it are that it's definitely not undervalued. So I can't really say it's a great buy here. And I'm partially influenced by the technicals too because it's currently downtrending. But I'll do a video on that in a second. But I can't say it's really undervalued, even from a fundamental standpoint, just based on the ratios I said. Unless they do, unless they somehow boost up revenue growth. But really, I had to think about this a lot, and it's just a really hard company to value just because they're still pretty new, as far as being established, and they just came to profitability more recently in time. So it's not really easy to look at history and say this is what they do every year, because every year has been different. So, and even the revenue is different every year. So the revenue growth. So, but if they can stabilize revenue growth and stabilize gross margins, then it's great. It's like you can start to say, it's an easy buy. At around 200 a share or something. But I just don't think it's a great buy here. Like, I mean, I think it'd be better lower, like in the hundreds. So that's just my thoughts looking at those basic things, at those basic metrics. So I hope that was helpful. And I'm not really biased. Like I don't own any shares of Tesla like individually. So I'd say it's pretty unbiased. Take on it. Like I said, this isn't financial advice or anything. I'm not a financial advisor. Like I used to be. I used to have securities licenses years ago, but that's just my thoughts, and take it what it is. But I hope this was helpful. Thanks.